Hi guys, Michelle Massio here. Thanks for checking in. Thanks for checking out my video. I'm going to do a quick video. Earlier this morning, I think it was, I did a quick video on stop orders and conditional orders. And I don't know what happened. I thought I uploaded it to YouTube and it was a wrong video. I've been doing tons and tons of videos lately, for this YouTube channel. And I have a couple Facebook groups and I have a class coming up. And I'm not sure, I guess I just mixed something up. So I'm just going to re-record it. I couldn't find it. But it is super important, and I do want to let people know how it works. So I want to talk a little bit about stop orders and conditional orders. So making money in the stock market is super easy, and protecting your money and risk management is sometimes and oftentimes much more challenging. So it's super important to manage your risk and make sure you don't lose money. So it's easy to make money, harder not to lose it. One way to avoid or help avoid losing money, or especially significant amounts of money, is to use stop orders, right? So like when I trade options, I do it in a couple different ways. I trade covered calls, I sell covered calls, and I also sell puts. I'm not going to go into all those details right now. I do have other videos for that, but I'm going to talk about covered calls and when you're long stock. So basically, how I manage risk is, and I think this is very helpful for people, and stay tuned because I'm going to give you two different ways to do this. When you buy stock, right? Let's say I buy ABC stock and I pay $100 per share. Really, it's important to think about ahead of time, before you place the trade, where you anticipate your profit to be, like where your target or expected target is going to go on the upside, right? As well as what your risk is. And that's important for a couple of reasons. Number one, really, when you trade, you want to remove the emotion out of things as much as possible, right? So if you don't have some sort of an idea ahead of time where your target is or where your risk is, um, it can become very emotional as the stock is trading, and going up and going down, or doing whatever it's doing, right? So you want to remove the emotion as much as possible. And also you want to have some sort of predefined risk on each position. So me personally, I typically will risk about maybe a quarter of a percent, maybe a half a percent on each individual trade on each position that I make. And the purpose of that is, number one, you can be wrong a whole bunch of times and still make money because you're limiting your risk in a very small way, right? So again, basically what you're doing is you're buying a stock and then you're placing a stop order at some predetermined level. So let's say you buy ABC at $100 and you say, okay, I want to risk $5 per share. You can put a stop order in at $95 per share. And the way that works is, if you put a stop order on the board, so to speak, like a stop loss order, it's also called. Basically, that means once it hits that price, it becomes a market order. Now, a couple things relative to that. Number one, oftentimes market makers will swing the market. A broker, actually, when I first started trading, I was back in 1997 is when I first started trading. I was trading commodity futures and options, and I was like 24 years old. And my broker at the time, 23, 24, something like that. My broker at the time, he told me lots of things. And one of the things that really stuck with me is that market makers will swing the market. So have you ever noticed that you place sometimes a trade and then you put a stop in? If you're familiar with stops, you put a stop in and it hits your stop and it bounces right back up again. It is said that market makers will swing the market. So, okay, so if we don't perhaps want to put a stop on the board because we don't want the market makers to swing it and then go back up, you can put what's called a conditional order in instead of a stop order, right? So once again, a stop order is you place a stop order at like a specific price. Once it hits that price, it becomes a market order and then it gets filled at the market, right? Instead of doing that, you can actually place a conditional order, right? And most custodians will allow a conditional order. And the way you do that is you are placing an order to, let's say I buy ABC stock at $100, right? And I want to risk $5 per share. I can place an order to sell at the market after ABC goes down, equals, or goes below $95. So basically, it's not like, so to speak, on the board and let's say viewable or visible or as visible, but basically it's held at the custodian, and it's going to become a market order after the price trades through a certain amount. So I personally have been doing my stop orders more in that fashion rather than placing a stop on the board. Um, so I hope that makes sense. I hope that clears things up. Also, one other thing to note: if you are trading options, so I trade options and I sell options, right? So, for example, I will buy ABC stock, let's say at $100. I might place a conditional order to sell at 95, right? So once it becomes 95 or lower, it becomes a market order, and I sell those shares. If I am also short a covered call, I can also at the same time place a conditional order to buy back my short call if the stock goes below that certain price, which is my conditional order for my stop. And what that does is it makes everything automated and automatic. So one of the advantages of really trading, the big advantages, is that you can do it from anywhere, and it's kind of like money that is like not I used to say passive, maybe not so much passive anymore, but it is very different than people that trade their time for money, right? So historically, traditionally, many people will trade their time for money, which means that they have to actually do something, go to work, or do something, be somewhere in order to get paid, right? um, they do more of that, they get paid more. Investing and trading, particularly options, is very different. So you don't have to trade your time for money. That's how amazing it is. Like, you can travel, you can do this, you can do that. You can have all your orders, let's say, like predetermined, and then go out golfing for the day. Take your kids to the beach. I don't know, watch a movie with your husband or wife or whatever, or go for a run. The list is endless. And the whole purpose is you don't want to be like stuck and tied to your laptop, right? And seeing the screen. So really you want to make things as automated as possible. So what I do, and I hope this is helpful for you, um, again, is number one, when you have a trade, right? And I'm buying ABC at 100, I know ahead of time, okay, my target is that it's going to go X dollars, right? I'm on the plus side, right? On the favorable side. And my risk is that if it goes below X dollars or X percent, I'm going to sell out of it. So I'm only going to risk X percent or something like that. Typically, a good round number is what I do is I typically risk like 1/4%, maybe 0.5%, sometimes more. It depends on how I feel about the trade and the reason why I like it. But really, you want to have that number low, because if you make mistakes, you want to be able to make a lot of mistakes and still make a lot of money, right? So you want to make it very statistically based, right? That's how casinos do it. It's all statistics. It's like, okay, a slot machine will pay out 40% of the time, and whatever money that flows through, they're going to keep it 60% of the time. So it's all statistically based. You want to do your trading the same way, right? So when I enter a trade, I want to know, okay, what's my plus side, what's my downside, right? And I want to have that downside stop on the board, so to speak. Not necessarily a stop loss on the board, because again, market makers can swing it and bring it back up. But I want to put a conditional order to sell at the market once it goes below a certain price. So that's very important. And then also at the same time, I want to have a conditional order to buy back my short call if I get stopped out of the stock. You don't want to be naked to call, right? If you don't know what that means, watch another one of my videos, or if I don't have another video on YouTube, I'm going to put one on there at some point, because I've been putting a lot of videos on as time has been going on. But basically, you want to have covered calls, not naked calls. What that means is you want to own the shares and then short a call. That means that, okay, let me give you an example. I'm going to expand on this a little bit. It's kind of like leasing to own a house or something like that, right? So I own Apple stock, right? I own 100 shares of Apple stock, and I buy 100 shares at 100. I'm just going to use round numbers, and then I'm going to sell a call at, let's say, $105, which means that if Apple is 105 or higher between now and the expiration date, I'm going to sell my shares at 105, which is good because I paid 100, I sell them at 105. Plus, I keep the premium for the calls. Life is good, right? So that's a covered call. Covered means you already own the shares, right? Very, very conservative. So it's like one of the most conservative things that you should do. And in fact, a lot of people, like, I used to manage money for clients, and one of my investors a short time ago, he had a bunch of Amazon and Adobe and all these different things. And I'm like, dude, you should be selling calls on your stock and taking extra money, because you can sell a call that's kind of far out of the money. And worst case scenario, I mean, the worst case scenario when you sell a covered call is if the stock skyrockets, you might miss out on some of the upside potential, but you're taking in guaranteed income. So I always another thing that my original broker, it's funny how things stick into our brain sometimes. When I was trading commodity futures and options a long time ago, pigs get slaughtered. He would say, "Don't be greedy in the marketplace, Michelle. Pigs get slaughtered." So, and I have this options group, and I tell my people in this group all the time, don't be greedy. If you're making money, don't say, "Oh my gosh, I should have made more," or blah, 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 "I should have done this," or second guess yourself after the fact, right? Don't beat yourself up. This doesn't solve anything, right? Be happy that you made money. So the worst case scenario when you're selling a covered call is the stock zooms and you miss a little bit of upside, right? That's not that bad of a deal. So that's kind of, how covered call works. A naked call is like I'm selling a call and I don't have the shares. And really that's very aggressive. And aggressive is kind of like a downplayed word. It's risky. I'll just say it like that, because stocks can just go to infinity, right? Stocks can literally go to infinity. And because of that, you don't want to be naked a call. You only want to sell covered calls. You could be naked puts, which means that you're going to buy the stock if it drops below a certain price. I'm going to have another video. I'm sure I have other videos on that as well, so you can check out one of those. But my point here in this video that I'm talking about is don't be naked a call. So really covered calls are where you want to be, and it's more conservative. So stops are important. Protect your money, right? So it's important to keep your risk management proper. And doing that is that you have stops on stock. So you don't want to ride it all the way down. You can always buy it back again if it goes down. Another tip, people, is that let's say I buy 100 shares of ABC at 100 and my stop is 95. I also want to look at the charts ahead of time and say, okay, well, I still like ABC stock because fundamentally I'm always going to trade something that I kind of believe in and like long term, right? That's like the general fundamental of it. And a good idea ahead of time is to say to yourself, when you're looking at charts and you're analyzing sort of price patterns and things like that, if it does go down and if I do get stopped out, where would I want to rebuy that? Or I can sell a put to rebuy it at that lower price. I'm not going to, get too much in the weeds on this video. This video was meant to talk about putting a stop on the board versus a conditional order. So I hope this helps. I have no idea what happened. I swear I recorded this video earlier this morning and then I put it on YouTube and then I put it on my Facebook channel and I had a bunch of likes and stuff and a bunch of views. And then one guy posted like, "Oh my gosh, Michelle, this is like a commercial for your class or something." It's cool, but where's the information about stops and conditional orders? So sorry about that for the confusion. Hope this helps. I hope all my information always helps. I'm trying to do videos on different topics as I go. Subscribe to the channel, like the video. If it's helpful, hit me up and send me a message if you want to see a video of something else. And in the meantime, happy trading. Bye.